Today, we are going to explore one of the most fascinating and controversial topics in the history of financial markets: the relationship between the price-to-earnings ratio in Europe and the United States from 1990 to 2024. We'll do this through a dynamic chart carefully crafted using data from the BlackRock Investment Institute and L.CG datastream from December 2024. This chart reveals the ups and downs of European stock valuations compared to their U.S. counterparts over more than 3 decades. As we progress through this analysis, we'll not only observe the visual trends in the chart but also examine the economic, political, and financial factors that have driven the periods of growth and decline in this historic face-off between Europe and the United States. We begin our journey in 1990. This initial period is marked by a sharp decline in the European price-to-earnings ratio during the early years. What happened? Largely, it was the result of a global recession triggered by the Gulf War crisis and the economic impact of the Soviet Union's collapse on European markets. However, between 1993 and 1995, Europe experienced a remarkable rebound, pushing the ratio to historic highs. This ascent was fueled by economic recovery following reforms in key European Union countries and optimism surrounding the European Economic Integration Project. The Maastricht Treaty, signed in 1992, generated significant investor confidence. But the optimism didn't last. By the end of 1996, European valuations suffered a sharp correction due to uneven economic growth and concerns over monetary stability ahead of the euro's introduction. This period demonstrates how structural changes can drive substantial movements, but also how expectations don't always align with economic realities. The next segment, from 1996 to 2001, shows an initial recovery that is soon interrupted by a sharp decline in valuations. By the late 1990s, Europe tried to keep up with the technological explosion led by the United States. However, it failed to replicate the massive growth of the U.S. tech sector. During the dot-com bubble, U.S. tech companies attracted massive capital flows, inflating valuations in that market, while Europe lagged behind. This difference in risk appetite between U.S. and European investors translated into a relative decline in Europe's price-to-earnings ratio. Despite this, Europe showed moderate recovery by late 2000 and early 2001. This coincided with the bursting of the dot-com bubble in the U.S., leading some investors to seek refuge in more stable sectors typical of European economies. After the dot-com bubble, the period between 2001 and 2006 shows much more stable behavior, although with a general downward trend. This segment is characterized by an initial decline followed by lateral movement. During this time, Europe faced significant structural challenges. The 2004 enlargement of the European Union brought economic diversity but also added pressure on the bloc's largest economies. Additionally, the lack of significant growth in innovative and technological sectors kept European valuations relatively low compared to the US, which was beginning a rapid recovery. This stage highlights how Europe began to establish itself as a discount market relative to the US, a trend that would persist in subsequent decades. This period is one of the most dramatic in the chart. Between 2006 and 2011, Europe hit historic lows in the price-to-earnings ratio. This was directly related to the 2008 global financial crisis. While the collapse of Lehman Brothers and the subprime mortgage crisis affected the entire world, Europe faced additional problems: the sovereign debt crisis in countries like Greece, Portugal, and Ireland. Uncertainty about the euro's stability and the strict austerity policies implemented in response to the crisis led to a significant decline in valuations. Although there was a slight recovery toward the end of this period, confidence in European markets remained low, limiting the scope of any significant rebound. Between 2011 and 2016, Europe finally began to show signs of recovery. This period was marked by expansive monetary policies from the European Central Bank, ECB, including ultra-low interest rates and a bond-buying program known as quantitative easing. Despite these measures, Europe failed to surpass the US in valuation growth. The US economy, driven by technological innovation, the shale oil boom, and a faster recovery from the financial crisis, continue to attract greater investment flows. This segment of the chart reflects how Europe managed to stabilize, but without the capacity to compete with the economic and financial dynamism of the US. The period between 2016 and 2021 shows a reversal of the recovery trend. Europe once again entered a downward phase, approaching the historic lows of 2007. This was partly due to the impact of Brexit, which generated significant uncertainty in European markets. Additionally, global trade conflicts and growing tensions between the US and China negatively impacted Europe's export-driven economies. The COVID-19 pandemic, which began in 2020, further exacerbated these tensions. Although central banks responded with extraordinary measures, Europe's recovery was slower compared to the US, where massive fiscal stimulus and leadership in vaccination efforts drove a faster rebound. Finally, we arrive at the current period, from 2021 to 2024, where Europe reaches new historic lows in the price-to-earnings ratio. This segment reflects a clear deterioration in European valuations. Several factors explain this trend. First, energy uncertainty stemming from the war in Ukraine and the transition to renewable energy has deeply impacted European economies. Additionally, stricter monetary policies implemented by central banks to combat inflation have limited economic growth. In contrast, the United States has continued to benefit from its strength in high-tech sectors and its ability to attract global investment. This differential has widened even further, pushing Europe to a new historic low in 2024. Looking at this journey of over 3 decades, it's clear that the price-to-earnings ratio relationship between Europe and the United States reflects more than just numbers. It's an indicator of structural differences, economic dynamics, and the ability to adapt to a constantly changing world. Looking ahead, one of the key questions investors must consider is whether Europe can leverage its policies and innovations to close the valuation gap with the US. The transition to renewable energy, investments in green technology, and a focus on sustainability could position Europe for growth in sectors where it has historically lagged. At the same time, geopolitical challenges and shifts in global trade dynamics may create opportunities for the region to strengthen its economic foundations. However, sustained progress will require overcoming structural inefficiencies and embracing more aggressive innovation strategies. The interplay between these factors will determine whether Europe remains a discount market or emerges as a competitive force in the global financial landscape. While Europe has faced significant challenges, there are also reasons for optimism. Recent sustainability and digitalization policies could help revitalize the European market in the coming years. On the other hand, the US continues to lead in innovation and capital attraction but faces its own challenges, such as increasing public debt and growing global competition. This chart not only tells a story of the past but also offers key lessons for investors seeking to understand global trends and make informed decisions. Will the future bring a turnaround for Europe? Only time will tell. And if you want to learn more about the development of the automotive sector by country, don't miss the video on screen, where you'll discover surprising insights into which nation is leading this competitive industry. You won't want to miss it.